Welcome to the deep dive. We're here to cut through the noise, pull together the complex stuff, and really get to the heart of what matters in crypto.
That's the plan.
And today, we're diving into something pretty pivotal, actually. A development that's already making waves, from the biggest institutions right down to individual DeFi users.
Yeah, this isn't just another headline. It feels different.
It really does. We're looking at a rare regulatory moment, something a lot of people are calling a potential game changer.
It really captures that ongoing, sometimes tense conversation between traditional finance, the regulators, and, well, the whole fast-moving world of crypto and DeFi.
Exactly.
For a lot of folks in this space, I think it felt like a collective exhale, a sigh of relief, maybe. And it gives us a fascinating look at how regulators might be starting to grapple with the real complexities of DeFi.
Definitely. So our deep dive today focuses squarely on the latest guidance from the U.S. Securities and Exchange Commission, the SEC, specifically what they said about liquid staking tokens.
And this is the guidance that's being widely called a big win for DeFi, right? A boost for institutional adoption, too.
That's the narrative, yeah. A significant win. So our mission today, for you listening, is really threefold. We want to unpack exactly what the SEC staff actually said.
Right.
We need to understand why it's causing such excitement. And crucially, how does this all connect back to those fundamental legal tests, like Howey, that determine what even is a security under U.S. law?
And explore the ripple effects, the implications across the whole crypto market.
Absolutely. But, and this is important, we won't just focus on the cheers. We're also going to look closely at the dissenting voices within the SEC itself.
Because there was pushback, significant pushback.
Exactly. We need that balance to give you a truly comprehensive picture. It's rarely simple, this stuff.
Never is.
So to do this, we've gathered insights from all over. We're looking at detailed reports from places like Cointelegraph and The Block.
Yep.
We've got direct takes from key industry players. Think Mara Schmidt from Alluvial, Lucas Bruder at Jito Labs.
People on the ground building this stuff.
And legal analysis from experts like Catherine Dowling at Bitwise and Jason Gottlieb from Morrison Cohen.
Essential perspectives on the legal interpretation.
Plus, statements directly from SEC officials Chairman Paul Atkins, Commissioner Caroline Crenshaw. We're synthesizing all of it.
Okay, let's get into it. Where do we start? The win itself.
The win, what the SEC said, and why the crypto industry is cheering.
Let's start right there. The headline news.
Yeah.
The thing that's got everyone talking. This idea of a clearer path for liquid staking.
Okay.
The core of it comes from this SEC staff guidance released Tuesday, August 5th, 2025. And, the central point is pretty huge.
Yeah.
For the first time, the SEC staff explicitly stated that if certain conditions are met, these liquid staking activities and the receipt tokens you get from them, they do not constitute securities offerings.
Wow. Okay. That is a big deal. Not just a clarification, but a specific do not constitute security statement.
Exactly. A profound distinction. What do you say?
Oh, absolutely. Profoundly important. The significance of saying something isn't a security offering. You can't really overstate that in this climate.
Right.
Because for quite a while now, liquid staking has been operating under this sort of regulatory cloud. Uncertainty loomed large.
Yeah, that ambiguity was a real problem.
It wasn't just theoretical either. It was a practical roadblock. You had companies maybe hesitating to innovate, right? Institutional money, definitely wary about jumping in big.
Sure.
Development felt kind of constrained, held back by the unknown. So this guidance, for many, it finally provides a framework, clearer rules of the road.
A framework.
Yeah.
Like a regulatory green light, maybe? Albeit, as you said, one with conditions attached.
That's a good way to put it. A green light, but you have to follow the specific directions on the map they've drawn. It allows for much more confident engagement, though.
And that map seems welcome. We keep hearing it called a major step forward by, pretty much everyone involved. Mara Schmidt, she's the CEO at Alluvial, the blockchain dev company. She put it really clearly.
And what did she say?
She said, this decision sets the stage for a wave of new products and services that will accelerate mainstream participation in digital asset markets. Mainstream participation. What does that actually look like for you listening at home?
Well, it means quite a bit, potentially. For you, whether you're already deep in DeFi or maybe just crypto curious, this clarity reduces the perceived risk for the companies building the products you might use.
Okay.
Think about it. A company might have held back on launching a cool new liquid staking feature because they feared unpredictable regulatory action. Now they have a clearer idea of the boundaries.
So they might actually build it now.
Exactly, which means they could potentially offer you more regulated, more robust, maybe even easier to use products that involve liquid staking. It helps build trust on like a foundation of actual regulatory understanding.
Which could lead to wider adoption.
Precisely. Imagine smoother integrations with financial services you already use, or just easier ways to access yield, all within a clear regulatory zone.
And the reaction from the industry reflects that. It wasn't just immediate, it was uh, overwhelmingly positive from what we're seeing.
Yeah, it seems that way.
It's not being seen as just some small technical fix.
hmm
People are calling it a rare regulatory win. That phrase alone, rare regulatory win, tells you a lot, doesn't it?
It speaks volumes. It really highlights how much the industry has been craving any kind of positive clarity, any pathway forward that isn't just enforcement.
So what's the feeling? Optimism?
Cautious optimism, I'd say, but definitely optimism. And the key thing here is how this translates into institutional confidence.
Right, the big money.
Yeah. Institutions that might have been on the sidelines, held back by their legal and compliance teams, well, now they can now confidently integrate LSTs, liquid staking tokens, into their products.
And that's not just about checking a box, is it?
Not at all. This is about unlocking completely new business lines, new market structures. Schmidt from Alluvial again, she talked about how this will drive new revenue streams, expand customer bases, and enable the creation of secondary markets for staked assets.
Secondary markets.
Yeah.
So trading the state asset receipts themselves.
Exactly. Think about new structured products built on LSTs, prime brokers offering more services around staked assets, maybe even derivatives markets based on these things. It's a confidence booster that could, unfreeze capital that was just sitting there.
Waiting for the green light.
Pretty much.
Right.
Encouraging investment across the board.
And what's really interesting, I think, is that this isn't being seen as just some, superficial thumbs up. Lucas Bruder, the CEO of Jito Labs.
Yeah, Jito.
Right. He specifically noted that the guidance shows the same nuanced understanding of LST technology that the Crypto Task Force exhibited when we met with him back in February.
Okay, that is interesting. It suggests the regulators actually dug in.
It implies they listened, they engaged with the tech, tried to understand how it really works, rather than just painting with a broad brush.
And that nuanced understanding is just critical. It's a shift away from, regulation by enforcement, maybe, towards actually engaging with the specifics. Catherine Dowling over at Bitwise, their general counsel and CCO.
What was her take?
She reinforced this, saying the SEC is making clear that certain liquid staking activities do not involve securities. Emphasizing that word, certain.
Ah, the qualifier. Always important.
Paramount, really. It's not a free-for-all for every type of liquid staking. It's a specific path for those who operate in a particular way, especially regarding how involved the service provider is.
So it's that precision that gives institutions the comfort they need.
That seems to be the case. It defines the safe harbor, if you will.
Okay, so let me try and summarize this part. This clarity, this win, it's like a key potentially unlocking institutional money that was stuck on the sidelines due to legal fog.
It's a good way to think about it.
And it's not just a technical point. It boosts confidence, could spark a wave of investment, innovation, new products we haven't even thought of yet.
That's the hope, definitely.
Deconstructing liquid staking and the Howey test, the legal foundation.
Okay, so to really get why this is such a big deal and understand those all-important certain conditions, we need to unpack two things. Liquid staking itself, and then connect it to the big legal test the SEC uses, the Howey test.
Right, the foundation of securities law for, decades.
Let's start with liquid staking. For anyone listening who isn't deep in the weeds on this, what is it, basically?
Okay, so at its core, liquid staking is a clever fix for a problem in many proof-of-stake blockchains. You know how in traditional staking, you lock up your crypto to help run the network and earn rewards?
Yeah, you stake your coins, support the network, get more coins.
Right. But the catch is, while those coins are locked, they're illiquid. You can't sell them, you can't use them in DeFi protocols, nothing. They're stuck.
Until you unstake, which can take time.
Exactly. Sometimes days or weeks. Liquid staking solves this. The process is basically, you deposit your stakeable crypto, like ETH, SOL, etc., with a third-party provider or maybe a decentralized protocol. And in return, immediately, you get back these special tokens. They're often called staking receipt tokens or liquid staking tokens, LSTs.
And these receipt tokens, they're the key, right? They're not just an IOU.
Not at all. They're much more dynamic. Their critical function is providing instant liquidity. You can trade these LSTs on decentralized exchanges. You use them as collateral to borrow other assets. You can put them into yield farms.
All while your original crypto is still staked and earning rewards?
Precisely. You don't have to wait for that unstaking period. It neatly gets around those lockup constraints.
Okay, maybe an analogy would help here.
Sure. Think about, imagine you own a bunch of gold. You put it in a secure vault that pays you a small yield for storing it there. But while it's in the vault, you can't use the gold itself.
Right, it's locked away.
Now, what if the vault gives you a digital, verifiable warehouse receipt for that gold? This receipt isn't the gold, but it represents your gold in the vault. And crucially, you can instantly trade that receipt or use it as collateral.
While the actual gold stays put, earning yield.
Exactly. The receipt is liquid, the underlying asset is staked and earning. The LST is like that warehouse receipt.
That makes it very clear. And you can see why that's so appealing, right? For you, the user, you get to support the network, earn rewards, and keep your capital flexible for other DeFi opportunities.
It's capital efficiency, seamless access. It lets your assets do two things at once, essentially.
Okay, so that's liquid staking. Now, how does the SEC decide if that process or the tokens involved count as a security? Enter the Howey test.
The cornerstone. The Howey test comes from a 1946 Supreme Court case involving citrus groves, believe it or not.
Ah, yeah, the classics.
And it lays out a four-part test to determine if something is an investment contract, which is a type of security.
And that test is an investment of money.
Check. You invest your crypto.
In a common enterprise.
Check. Usually the staking pool or protocol.
With a reasonable expectation of profit.
Checked. Staking rewards.
To be derived solely from the entrepreneurial or managerial efforts of others. And that last part is the battleground, isn't it?
Always. That efforts of others prong is where almost all the crypto securities debates happen. Are the profits coming just from the network protocol itself or from the specific actions and decisions of the liquid staking provider?
So how did the SEC apply Howey in this new guidance?
This is where the crucial distinction comes in. The SEC staff said that if a liquid staking provider performs only administrative or ministerial functions. That's the magic phrase.
Administrative or ministerial? Like what?
Like just handling the technical process of staking, issuing the receipt token that simply represents ownership of the underlying staked asset, passing through the staking rewards without taking some active management role.
So basically acting like a facilitator, not a fund manager?
Pretty much. If their role is truly passive and non-discretionary in that way, the SEC staff says those activities may not meet the efforts of others, prong of Howey, and therefore wouldn't trigger securities registration. It's a specific carve-out.
And they deliberately called these staking receipt tokens, right? That specific language matters.
It seems intentional, yes. It helps define the scope. This isn't necessarily about all complex tokens, but specifically these kinds of receipt tokens linked directly to staked assets under these conditions. It creates a category.
Okay. And who does this potentially apply to? You mentioned some names earlier.
Yeah, the guidance could offer a clearer path for some of the big players out there. Think Lido, Steve, Marinade Finance, MSOL, Jitosol, maybe Stakewise, Seeth2. These are major protocols handling billions in assets.
So concrete examples of who might fit into this administrative bucket?
Potentially, yes. But again, the nuance is critical. It's not all liquid staking automatically exempt. The nature of the provider's activities is key.
What tips it over the edge?
Well, if the provider is doing more than just facilitating, are they actively managing the staked assets? Making discretionary decisions about where or how to stake for optimal yield, pooling funds in a way that looks more like a collective investment scheme rather than just passing through network rewards.
So if they're actively trying to generate extra profit through their management beyond the basic staking yield.
That's likely where the line gets crossed into potentially triggering securities laws. It's about whether their entrepreneurial or managerial efforts are what you're relying on for profit. It's a legal tightrope.
A very fine line, it sounds like, where future fights might happen.
Almost certainly. Determining what counts as purely administrative versus managerial in complex DeFi protocols, that's where the lawyers will learn their keep.
Broader implications catalyzing institutional engagement and ETF progress.
Okay, so this guidance didn't just appear out of nowhere. It seems to fit into a broader context, maybe a shift in tone from the SEC under the current administration.
It certainly seems that way. There's been talk and reporting suggesting the Trump administration's SEC is aiming for a stance that's, let's say, More welcoming toward crypto compared to perhaps the previous leadership.
A crypto-friendly era, some are
Yeah.
calling it.
Right. And this liquid staking guidance seems to align with that narrative. It's providing clarity rather than just bringing enforcement actions, which the industry has been asking for.
And wasn't there a new initiative announced recently, Project Crypto?
Yes, exactly. SEC Chair Paul Atkins rolled out Project Crypto just last week. It's not just a name, it's supposed to be a focused effort to update the agency's rules on crypto, things like distributions, custody, trading, areas where the old rules just don't fit well.
So this LST guidance could be an early product of Project Crypto.
It's plausible. It fits the stated goal of modernizing the rules and providing clarity. Maybe it's a signal of how they intend to approach other complex crypto issues.
And we should remember they already kind of paved the way for this back in May, didn't they?
Good point. Back in May, the SEC had already said that basic proof of stake, staking itself, just participating in network consensus, doesn't constitute a securities transaction.
So this new guidance builds on that. First, staking isn't a security. Now, under certain conditions, the liquid tokens representing that stake also aren't securities offerings.
Exactly. It expands that zone of activity viewed as potentially outside the SEC's direct securities jurisdiction, as long as you stick to those administrative functions we talked about.
And Chairman Atkins himself commented on this, right?
He did. He put out a statement saying, "Today's staff statement on liquid staking is a significant step forward in clarifying the staff's view about crypto asset activities that do not fall within the SEC's jurisdiction."
Pretty direct.
And he added he was satisfied that the Project Crypto initiative is already producing results. So it's being framed as part of this larger proactive effort.
Which signals,
Yeah,
what? A more innovation-friendly environment.
potentially. It suggests an approach aiming to balance investor protection with allowing the industry room to grow and innovate within clearer guidelines, rather than maybe stifling things through uncertainty or overly broad enforcement.
Okay, now let's talk about one of the biggest potential impacts everyone's buzzing about. Spot Ethereum ETFs. How does this LST guidance connect?
Ah, yes. This is huge. Many observers see this guidance as a major step, maybe even the final step needed for the SEC to approve staking within those spot Ether ETFs that are already approved for trading.
The ETFs exist, but they can't stake the E's inside them yet.
Correct. And adding staking is seen as critical for competitiveness and reflecting the true nature of ETH as an asset. Nate Gerasi, president of Novatius Wealth, he was quite blunt about it.
What did he say?
He called this guidance the last hurdle in order for SEC to approve staking in spot SEF ETFs.
Wow. The last hurdle. Why? What was the problem that this solves?
The reasoning, according to Gerasi and others, is that liquid staking tokens will be used to help manage liquidity win spot F ETFs, something that was a concern for SEC.
Okay, unpack that. How do LSTs help ETF liquidity?
Think about a massive ETF holding millions of ETH. People are constantly buying and selling shares of the ETF, creations and redemptions. If the underlying ETH is staked and unstaking takes days or weeks.
You have a liquidity problem. You can't quickly get the ETH back to meet redemptions.
Exactly. It creates operational headaches and potential tracking errors. But if the ETF can hold LSTs representing the staked ETH, or use LSTs as part of its mechanism.
It maintains liquidity through the tradable LST, even while the underlying ETH is staked and earning yield for the fund.
Precisely. It offers an on-chain, efficient solution to that specific regulatory worry about managing liquidity in a staked ETF. It seems to address a key SEC concern head-on.
Makes perfect sense. And are the ETF issuers reacting?
Immediately. Reports indicate firms like BlackRock are already looking to amend their existing spot ETH ETF filings to explicitly allow for staking, likely using mechanisms enabled by this guidance.
That's fast. Shows how much
Yeah.
they were waiting for this.
Absolutely. It signals the industry sees this as a green light to move forward with integrating staking into these mainstream products.
And if staking gets approved in ETH ETFs,
Right.
what's the bigger picture?
Oh, it could be transformative. Huge potential inflows of institutional capital into staked ETH through a familiar regulated vehicle.
Right.
But beyond ETH, it sets a massive precedent. It creates a potential regulatory template for how other proof-of-stake assets, think Solana, Cardano, others, could eventually be included in ETFs or similar products with staking enabled.
So it's a pathway for integrating the core mechanic of these network staking into traditional finance.
Exactly. Bringing legitimacy, maturity, maybe more stability to the whole digital asset market. It's not just about Ether. It's about a model for a whole class of assets.
And the implications might go even wider than LSTs and ETFs, right? What about other kinds of receipt tokens?
Yeah, this is another fascinating angle. Jason Gottlieb, a partner at Morrison Cohen, pointed this out. He said the SEC statement has significant implications for other cryptocurrency matters, particularly including receipt tokens for cross-chain bridging or other similar wrapped tokens.
Like wrapped Bitcoin, WBTC on Ethereum,
Uh-huh.
or tokens you get when you bridge assets between chains.
Exactly. His argument is, by the same logic the SEC staff use for LSTs, if the token just represents an underlying asset held elsewhere, and the issuer is only performing passive administrative functions.
Then maybe those tokens are also simply receipts and cannot, without more, be securities.
That's the argument. If that principle holds, it could provide regulatory clarity for a huge range of tokens that are fundamental to DeFi interoperability and even tokenizing real-world assets.
Wow, that would be significant, a potential blueprint for lots of different things.
It could unlock a lot of innovation that's maybe been hesitant due to regulatory fog around these wrapped or bridged assets. It offers a potential legal basis for many core DeFi building blocks.
Okay, let's bring it back home. How does all this potentially benefit you, the listener, the individual user?
Well, Mara Schmidt touched on this again. She highlighted that retail platforms will be able to attract more users by providing seamless access to staking rewards without lockup constraints.
So for everyday users on crypto platforms or exchanges, it could mean easier, more flexible ways to earn yield.
That's the idea, less friction. You don't have to choose between earning staking rewards and needing your capital available for something else. You can potentially do both more easily.
Better capital efficiency for everyone, not just institutions.
Right. And the broader ecosystem benefits she mentioned, increased liquidity and innovation, those trickle down too. More liquidity usually means better pricing and tighter spreads when you trade. More innovation means potentially cooler products and services become available.
So institutional clarity isn't just for the suits. It enhances the whole ecosystem.
That's the theory. A rising tide lifts all boats, perhaps. It signals market maturation that ultimately benefits all participants, from the smallest retail user to the largest fund.
This dissenting voice, a note of caution and uncertainty.
Okay, so we've heard a lot about the win, the excitement, the potential upside. But as we flagged at the start, this wasn't a unanimous decision within the SEC. We absolutely have to talk about the dissent.
Yes, crucial to get the full picture. Commissioner Caroline Crenshaw issued what's been described as a sharp dissent. She wasn't just mildly disagreeing.
A sharp dissent? What were her main points? Why push back so strongly?
Her core argument, reading her statements, is that she believes the staff's guidance relies on shaky assumptions and ultimately offers little regulatory certainty.
Okay, shaky assumptions and little regulatory certainty. That's pretty damning. What assumptions does she think are shaky?
Well, it seems her concern centers on that distinction between administrative or ministerial functions versus entrepreneurial or managerial efforts.
The line we talked about earlier.
Exactly. She seems skeptical that this line can be drawn so clearly and reliably, especially in the context of complex, evolving DeFi protocols. She might worry that providers could design their systems to look purely administrative on the surface,
While still retaining some level of control or influence that benefits them and impacts investor outcomes.
That seems to be the concern, a potential loophole.
Yeah.
Is the distinction robust enough to prevent bad actors from exploiting it? That's the underlying question her dissent raises.
And why little regulatory certainty? The industry seems to feel more certain now.
Her perspective seems to be longer term. She might argue that this specific carve-out doesn't establish a clear, overarching principle for future innovations. Instead, it might lead to endless, case-by-case fights over whether each new protocol variant fits the administrative definition.
So kicking the can down the road, in a way, creating future ambiguity.
That could be part of her thinking. She might also fundamentally disagree that merely pooling assets and issuing a liquid receipt, even with minimal issuer involvement, doesn't involve reliance on the efforts of others in a way that warrants securities protections.
Protecting investors from risks beyond just the issuer's management, maybe, like smart contract risk or centralization risk.
Precisely. Her dissent likely stems from a deep concern about investor protection. She might fear this guidance, interpreted broadly, could allow risky, unregistered products to flourish, harming retail investors who might not grasp all the underlying technological or economic risks, especially if they believe it's SEC approved in some sense, even though it's just staff guidance saying it's not a security offering under specific conditions.
So her dissent isn't just a technical disagreement. It's a fundamental difference in philosophy about where the regulatory parameters should be drawn for investor protection in DeFi.
It certainly appears that way.
Yeah.
It highlights that internal friction, that ongoing debate within the SEC itself about how to handle crypto.
And that friction is important for you, the listener, to understand, right? It means this win, while celebrated, isn't necessarily the final settled word.
Exactly. It's a crucial reminder that regulation in this space is dynamic, it's contested, there are strong, differing viewpoints even among the regulators. It adds that layer of complexity you need to consider when thinking about the long-term impact. Things can change. New interpretations can emerge.
Outro.
And that really brings us to the end of this particular deep dive. We've covered a lot of ground on what feels like a truly significant moment, this SEC staff guidance on liquid staking tokens.
Yeah, definitely transformative potential here. Accelerating institutional adoption, maybe paving the way for staked ETH ETFs, possibly broadening how we think about other receipt tokens. We looked closely at how it hinges on that specific read of the Howey test, that crucial difference between just being administrative versus active managerial effort.
But just as importantly, we didn't shy away from the Counterpoint Commissioner Crenshaw's dissent. A vital reminder that this regulatory path is still being debated and defined. It's not set in stone.
It's a complex, fascinating picture, and honestly one that's going to keep evolving.
No doubt about it.
And speaking of evolving and continuing, if you found today's deep dive useful or insightful, or maybe just helped clarify some things,
Hope so.
we genuinely appreciate it if you could take a second to support what we do, subscribing to the channel, maybe leaving a comment with your own take or a question you still have.
Sharing it with someone else who's trying to make sense of all this.
Exactly. All that engagement, it really does help us out. It boosts our visibility, lets the algorithms know people find this valuable, and frankly, it allows us to keep digging into these complex topics and bringing you this kind of analysis.
Your support genuinely makes a difference, so thanks if you do take that moment.
Truly appreciated. Okay, so, final thoughts. As you mull all this over, here's something to chew on, building on that dissent we discussed.
Let's hear it.
Given Commissioner Crenshaw's warnings about shaky assumptions and little regulatory certainty, how will this specific guidance actually shape the rules for other complex crypto assets down the road?
Good question.
If just issuing a receipt token for something you own under these administrative conditions doesn't trigger securities laws, what other digital representations might try to fit that mold? Tokenized real estate, carbon credits, cross-chain assets, where does that precedent lead?
And what's the lasting impact going to be on that fundamental balancing act? Fostering innovation in DeFi versus ensuring really robust investor protection in a space that changes so fast.
It's the billion-dollar question, isn't it? We are definitely in for an interesting ride figuring that out.
Indeed we are.
Thanks so much for joining us on the Deep Dive.
See you next time.